Hey, welcome. Today, we are cracking the code on what it really takes to build wealth. And we're going way beyond the usual advice to uncover the one thing that truly separates the wealthy from, well, everyone else. Here's a hint. It has a lot less to do with what's in your bank account and a whole lot more to do with what's going on in your brain.
So let's just jump right in with a huge question. We're always told, right, that to get rich, you need a bigger salary, a better job, some kind of lucky break. But what if that's not it? What if the real wall, the thing that's actually holding you back, has absolutely nothing to do with the numbers on your pay stub?
Yeah, what if it's all about the mental program, the financial software that's running in the background of your mind 24/7? That is the core idea we're diving into today. That true wealth, it's built from the inside out.
All right, so that brings us to our first major idea here, the wealth mindset shift. Because before you even think about a strategy or an investment, the journey has to start right between your ears.
Now check this out. This quote comes from a study of hundreds of self-made millionaires, and the discovery was just stunning. Over 90% of their success didn't come from a huge salary or some lucky stock pick. Nope, it came from a very specific mental framework. A program that was running in their brain that, get this, most of us don't even know exists.
And this slide right here perfectly illustrates the two different operating systems. On one side, you've got what's called the scarcity virus. It asks a simple question: can I afford this? And that question, it just shuts down all possibilities. It ends the conversation. But on the other side, you have the wealth builder mindset. It asks a totally different question. How can I afford this? That tiny switch turns your brain from a gatekeeper into a creative, problem-solving machine.
Okay, so once you've got the right mindset installed, how does money actually grow? Let's shift from the software in your head to the real-world mechanics.
You know, it all comes down to this absolutely timeless idea from Benjamin Franklin. Money makes money, and the money that money makes more money. This is the soul of compounding, the true engine of wealth creation. It's not just about your money working for you. It's about the returns on your money starting to work for you, too. And just look at this chart. This shows that principle in action, and it's beautiful. Over a 30-year period, look what happens. The money you first put in, it's the smallest part. The money you add along the way, yeah, that's significant, but over time, the returns, the money your money made all by itself, it just dwarfs everything else. That, my friends, is the magic of compounding.
And this is exactly why every single little bit matters. I mean, a tiny 1% difference in your investment returns might not feel like a big deal next year, but compounded over your lifetime, we're talking tens, maybe even hundreds of thousands of extra dollars in your pocket. It's huge. Now, this leads us to a concept that it feels kind of wrong to a lot of people, but for the wealthy, it's a secret weapon. Let's talk about the good debt secret. The key idea here is a powerful word: leverage. And put simply, it just means using other people's money, like a loan from a bank, to control a much bigger asset than you could ever afford on your own. And when you do that, you amplify your potential returns like crazy. Okay, let's make this super real with a simple example. Let's say you put down $1 million of your own money, and you borrow $2 million to buy a $3 million property. Now, the property value goes up by just 10%. When you sell it, you pay back that $2 million loan, you're left with $1.3 million. Your initial $1 million made a $300,000 profit. That's a 30% return on your money, even though the asset itself only grew by 10%. That is the incredible power of leverage. But, and I have to be really clear here, this is critical, not all debt is created equal. Good debt is when you borrow to buy assets that either grow in value or produce income, like a rental property. But it's a powerful tool, you have to respect it. Just as it can amplify your gains, it can also amplify your losses if that investment goes down. This is the complete opposite of bad debt, which is for consumption, buying stuff that loses value, often paid for with high-interest credit cards. Wealth builders focus on acquiring good debt, and they always understand the risks involved. Okay, so you get the mindset, you understand the power of compounding, and you see the secret of leverage. But how in the world do you put it all together into a plan that actually works? So let's talk about building your financial foundation. This right here is the investment hourglass. And honestly, it's a fantastic proven blueprint. It shows you exactly how to build your portfolio step by step, starting with the safest, most important things at the bottom, and then moving up to the higher risk, higher reward stuff. So let's break it down real quick. You always start at level 1, the foundation, a rock-solid emergency fund. You have to have that. Once that's secure, you move up to level 2, the core of your portfolio. This is where you use things like broad market index funds, which is really just a simple way to buy a tiny slice of the entire stock market at once. Then comes level 3, which is all about diversifying, spreading out your assets, maybe adding some real estate or international stocks to lower your risk. And only when all of that is in place do you even think about level 4, the opportunistic, riskier plays like picking individual stocks. Okay, now even with a perfect plan, there is one final boss you have to defeat, your own brain. This brings us right back to where we started, back to psychology. We have to talk about avoiding your brain's traps. You see, our brains are, well, they're hardwired with these hidden bugs. Psychologists call them cognitive biases. And these are basically mental shortcuts that, while they might have been useful for our ancestors, can be absolutely disastrous when it comes to making money decisions. They can literally make us our own worst financial enemy.
Okay, first up is a big one, loss aversion. Think about it. The pain of losing $100 feels way more intense than the pleasure of gaining $100, right? Well, that emotional tripwire causes investors to make a classic mistake, holding on to losing stocks for way too long, just hoping and praying they'll break even, instead of just cutting their losses and moving on.
All right, next we've got something called anchoring bias. This is our brain's weird tendency to get stuck on the very first piece of information we hear, like a stock's all-time high price. We anchor to that old number, and it completely clouds our judgment about what that asset is actually worth today. And finally, of course, there's the bandwagon effect, or what we all know as herd mentality. This is that powerful fear of missing out, that deep impulse to buy something just because it seems like everyone else is. This is exactly how speculative bubbles get started, and it's where smart, rational thinking goes to die. Wow, okay, we have covered a ton of ground. From mindset to mechanics to the mental traps that can trip us up. So the big question is, now what? Let's turn all this info into real action and talk about your first step today.
So I want you to ask yourself this question, personally. After everything we've just talked about, what is one single small, totally manageable step you can take today to start installing this new wealth-building software?
And look, to make it easy, here are 5 really powerful options. But here's the deal. Pick just one. Don't try to do them all at once. Real change, real transformation comes from small, consistent action. So maybe you just focus on changing your money language from "I can't" to "How can I?" Or maybe you try identity-based investing, which just means you decide "I am an investor" and you act on it, even if it's just setting up an automatic $5 weekly investment. Whatever you pick, commit to it. Master it for 30 days. Because that one consistent action, that's how you really begin to build wealth. The only question left is, which one will you choose?